Greetings, fellow sojourners on the winding path of economic upheaval. As we traverse the treacherous terrain of inflation, wage growth, and central bank policy pivots, a recent decision by the European Central Bank, ECB, has sent ripples through the financial landscape. On a fateful Thursday, the ECB, led by the steadfast Christine Lagarde, took a momentous stride by slashing interest rates by a quarter point, marking the first such move in nearly 5 years. This reduction, a symbolic salvo in the battle against the inflationary scourge that has gripped the continent, was hailed as a milestone in the quest to restore equilibrium to the economic cosmos. Yet, as is often the case in the realm of high finance, clarity is a rare commodity. Lagarde, ever the pragmatist, cautioned that future rate cuts would be contingent upon the elusive dance of price pressures and economic data. Her words echoed through the hallowed halls of the ECB's Frankfurt Citadel, a gentle reminder that the path ahead is paved with uncertainty. Indeed, several members of the Governing Council, those guardians of monetary orthodoxy, whispered to the esteemed Financial Times that another rate reduction in July seemed improbable, given the recent upswings in inflation and wage growth. The market's collective consciousness adjusted accordingly, with traders scaling back their bets on a September rate cut to a mere 60% probability. In a masterful display of rhetorical dexterity, the ECB proclaimed its refusal to pre-commit to a particular rate path, a stance that simultaneously emboldened and perplexed the financial cognoscenti. The bank's projections, imbued with a cautious optimism, foretold inflation lingering above the sacrosanct 2% target until the twilight of 2025. Catherine Nice, a former denizen of the Bank of England's hallowed halls, now a disciple of investor PGIM fixed income, astutely observed that the ECB had granted itself a bit more wiggle room for further caution, should the data fail to conform to their benign expectations. Amidst this tapestry of uncertainty, a lone voice of dissent emerged. Robert Holzmann, the hawkish overlord of Austria's central bank, stood resolute in his objection to the rate cut, asserting that data-based decisions should be data-based decisions. His concerns echoed those of another rate-setter, who questioned the consistency of the reduction with the recent inflationary and wage growth surges. Lagarde, ever the skilled orator, forecast a moderation in wage growth and an ascent in worker productivity over the coming year, a dynamic that could alleviate the labor cost burdens shouldered by companies. Dirk Schumacher, a former ECB economist turned acolyte of French bank Natixis, sagely opined that the ECB's baseline remains further cuts, contingent upon the elusive moderation of wage growth. As the financial world eagerly awaited Lagarde's pronouncements, the euro's value fluctuated, ultimately gaining a modest 0.1% against the mighty dollar. The interest rate-sensitive 2-year German bund yields, that benchmark of eurozone fortunes, inched higher, reflecting the inherent tensions within the ECB's decision. The ECB's move came on the heels of a kindred rate cut by the Bank of Canada and followed a chorus of central bank policy easings across the global economic stage, from Brazil and Mexico to Chile, Switzerland, and Sweden. Yet, the Federal Reserve in the United States remains poised to maintain its staunch stance, with rates expected to hold steady at a 23-year high range of 5.25% to 5.5%. A testament to the stubborn persistence of price pressures in the world's largest economy. Across the Atlantic, the venerable Bank of England is similarly anticipated to hold firm, with its bank rate unlikely to budge from its 16-year peak of 5.25% when the monetary mandarins convene on June 20. Amidst this cacophony of forecasts and policy maneuvers, the ECB lifted its growth projections for the current year from 0.6% to a more sanguine 0.9%. Its crystal ball envisions a 1.4% expansion next year, followed by a 1.6% ascent in 2026, a glimmer of hope amidst the economic tumult. As we bid farewell to this odyssey through the labyrinthine world of central banking, one cannot help but ponder the deeper implications of the ECB's decision. Is this a harbinger of better days to come, a turning point in the struggle against the inflationary scourge? Or is it a mere ephemeral respite, a momentary lull, before the next economic storm gathers strength? Only time, that mercurial arbiter of human affairs, can reveal the true consequences of this recent rate cut. For now, we must content ourselves with the knowledge that the guardians of the financial realm are ever vigilant, ever ready to wield the mighty instruments of monetary policy in service of economic stability. Until our paths cross again, my friends, may your portfolios prosper, your investments flourish, and your financial acumen ever sharpen in the face of adversity. For in the grand tapestry of economic fortunes, it is those who embrace uncertainty with equanimity and wisdom who shall ultimately prevail.